Imagine waking up to find that one of the world's main silver warehouses has quietly lost tens of millions of ounces in a matter of weeks. Prices are spiking, and the biggest futures exchange just had to halt trading because of a cooling failure. That is not a scene from a disaster movie. As of late 2025, COMEX silver stocks have dropped by roughly tens of millions of ounces from record highs in a few weeks, while the price of silver has surged toward all-time records. At the same time, the largest silver ETF on the planet, iShares Silver Trust, is sitting on over 500 million ounces of metal, an amount close to 60% of a full year of mine production. Investors are paying up for immediate delivery, with spot prices at times outmuscling futures. That's called backwardation, and in plain language it means people care more about having silver in hand today than a promise of silver sometime later. This isn't just about a price spike. It's about a fragile stack of paper contracts sitting on top of a shrinking pile of actual metal. We are deep into the third act of a four-act drama that has played out again and again in financial history. The final act is the one where paper promises fail, and only the people holding real metal get to walk away calmly. By the end of this video, you'll know exactly how this four-stage pattern works, what history tells us about the endgame, and what the Hunt brothers, palladium traders, and modern solar panel manufacturers are quietly screaming about today's silver market, and what you can do with that information before the script reaches its final scene. Let's start with the framework, because once you see it, you can't unsee it. Stage 1 is monetary trust. A commodity is treated as money. Governments anchor their currencies to it. Prices are boring, stable, predictable. Silver played this role for roughly a century and a half. U.S. dimes, quarters, and half dollars were made of 90% silver right up until the mid-1960s. For most of American history, you could literally walk into a bank, hand over paper notes, and walk out with metal in your pocket. Stage 2 is paper expansion. Once silver loses its formal monetary role, the financial industry discovers something far more profitable: selling claims on silver instead of silver itself. Futures contracts, unallocated accounts, certificates, and later ETFs multiply. For every ounce quietly sitting in a vault, there may be dozens of pieces of paper promising that ounce to someone. The numbers in the original script, 1 ounce, 10 paper claims, 50, 100, are illustrative, not precise, but the idea is simple. Paper is cheap to create. Mining ore out of rock is not. As these contracts proliferate, it looks like there is limitless supply. The visible price gets suppressed because the market is flooded with promises rather than bars. Stage 3 is the squeeze. Something changes. Either demand accelerates, confidence cracks, or both. People start asking for delivery instead of rollovers. Industrial users get nervous and pull more metal from warehouses. Investors look at the macro picture, deficits, debt, currency risk, and they stop trusting paper IOUs. Inventories begin to drain. Prices start acting strangely. Spot jumps above futures. Premiums over the quoted price widen. Stage 4 is the break. At some point, the math no longer works. There are more claims than ounces, and the system must choose: restructure, force cash settlement, change the rules, or blow up. Paper contracts lose credibility. Trading halts. Rules are rewritten on the fly. People who owned promises discover they didn't really own silver at all. People who already had metal sitting in a safe, they simply watch. The argument of this video is that silver is firmly in stage 3. To see why that matters, we need to revisit one of the most famous attempted corners in financial history. In the late 1970s, 2 Texas oil heirs, Nelson Bunker Hunt and William Herbert Hunt, decided they did not trust the dollar. Inflation in the U.S. ran above 13%. The gold window had been slammed shut in 1971, and the purchasing power of cash was visibly eroding. Their solution was simple: buy silver. Not a little. Almost everything they could get their hands on. At their peak, the Hunts reportedly controlled around 200 million ounces, a mix of physical bars and futures contracts. In early 1979, silver traded near $6 per ounce. By September, it was around $10. By January 1980, the price exploded to nearly $49 to $50. In roughly 12 months, silver had climbed more than sevenfold. On paper, the Hunts were among the richest men in America. But being right about the direction of a market is not the same as surviving the rule changes when your position threatens the system. The Hunts were not just speculating. They kept taking delivery, pulling physical metal out of the system. Each futures contract they insisted on converting into bars reduced the pool of metal available for others. The exchange saw risk. If too many players demanded delivery, the COMEX would be forced to admit it didn't have enough metal. So the rules changed. In January 1980, new regulations limited buying and made it much harder to hold large, long positions. Margin requirements were hiked. Suddenly, carrying those contracts became brutally expensive. The price collapsed. On Silver Thursday, March 27, 1980, silver plunged from over $21 to near $10, $11 in a single session, roughly a 50% crash in one day. The Hunts' highly leveraged positions imploded, delivering losses of around $1.7 billion and setting off a chain of stress for brokers and banks. Here's the part almost everyone forgets. People who simply bought physical silver at $6 and tucked it away still ended up with metal worth around $10, which is roughly two-thirds higher than their entry price even after the crash. The Hunts were not wrong about inflation or the long-term direction of precious metals. They were destroyed because they depended on leverage and paper contracts in a system where the referee can rewrite the rule book mid-game. That distinction between owning the asset and owning a promise is the heart of this entire story. The Hunt saga was not unique. When President Nixon closed the gold window in 1971, foreign governments had been redeeming dollars for physical gold. The United States simply did not have enough metal to meet all potential claims. The response was not to print more gold, but to stop redeeming. Over that decade, gold climbed from the fixed $35 per ounce level to peaks near $850, while silver marched from around $1.4 to almost $50. The paper claims dollars lost purchasing power. The physical anchors exploded higher. A similar dynamic appeared in the palladium market around 2000-2001. Russia, which typically supplies around 40–60% of global palladium, delayed shipments. Suddenly, an obscure auto catalyst metal became the focus of a full-blown panic. Prices more than doubled, rising by well over 200% in roughly 2 years. Traders who had sold futures assuming metal would magically appear were crushed when it didn't. Those who already owned physical bars watched prices surge in their favor. Different decades, different metals, different catalysts. Same core pattern. Too many claims on too little metal. A shock to supply or demand. A scramble for physical. Paper players discover what counterparty risk really means. Now, roll that pattern forward into a world that is trying to electrify everything, decarbonize power grids, and build out AI data centers and electric vehicles, all of which quietly depend on one particular metal. Gold is primarily a monetary and investment metal. If jewelry demand drops for a year, the lights do not go out. Silver is different. It is both a monetary metal and a critical industrial input. If silver fails to show up, you don't just disappoint collectors. You delay solar farms, slow down EV production, and interfere with high-end electronics and medical devices. Consider a few facts. Number 1. According to the World Silver Survey, the market posted a deficit of around 148.9 million ounces in 2024, and analysts expect another 9-figure shortfall in 2025. That would make 5 straight years where total demand exceeded total supply. Number 2. A study from the University of New South Wales modeled a world where current trends in solar deployment continue. In that scenario, photovoltaic demand alone could consume 85 and 98% of known silver reserves by 2050. Number 3. The solar sector's share of silver demand has climbed from roughly 12% in 2020 to a mid-teens percentage today, as silver usage in solar cells has surged into the hundreds of millions of ounces per year. Now put this in industrial context. Solar panels, EVs, 5G towers, advanced medical equipment, AI data centers, each uses silver for its unmatched electrical and thermal conductivity. Unlike many commodities, when silver goes into a solar cell or a tiny circuit, it is uneconomic to recover. A large portion of industrial silver is effectively gone for good. At the same time, Mining output has struggled to grow, and recycling is not closing the gap. The result is a multi-year structural deficit, more silver being used than brought to market. Under normal circumstances, the price would rise until supply and demand rebalanced. But remember stage 2. As long as the world is happy to hold paper silver, ETFs, futures, unallocated accounts, the system can pretend there is more metal available than actually exists. The tipping point is when big players start saying, "Thanks, but I'll take delivery." So what does stage 3 look like today? 1. Warehouse trends. COMEX silver inventories hit record levels in 2025 and then began to fall sharply. From early October, roughly tens of millions of ounces have flowed out of warehouses. That kind of decline may not be the single biggest in history, but it is one of the most significant drawdowns in years, and it is happening in the context of a structural deficit rather than a surplus. 2. ETF accumulation. iShares. Silver Trust alone now holds over 500 million ounces of silver, more than half of global annual mine production. That means a huge slice of above-ground silver is effectively locked inside a financial product whose shareholders mostly never touch a bar. 3. Policy and banking signals. In February 2025, several major South Korean banks temporarily halted or restricted silver bar sales to retail customers due to inventory shortages and volatility. In China, regulators have tightened rules around precious metal trading for individuals and prioritized state and industrial needs. India, meanwhile, has been importing record amounts of silver as households and manufacturers position for currency and inflation risk. 4. Price behavior and premiums. Spot silver has, at times, traded above futures, a classic sign of backwardation. Retail buyers routinely pay a few dollars over spot for common bullion products and significantly more for popular coins. That gap is the market quietly saying, the posted price on a screen is not the full story. 5. Exchange stress. In November 2025, a key commodities exchange experienced a trading halt in part of its infrastructure, officially attributed to a cooling system failure. Whether you accept the explanation at face value or not, seasoned traders know that sudden halts in the middle of fast markets are often associated with large, stressed positions on someone's balance sheet. Put all of this together: shrinking warehouse inventories, huge ETF stockpiles, multi-year deficits, industrial demand that cannot easily be dialed down, and odd behavior in banks and exchanges, and you have a textbook stage 3 squeeze setting up. What happens if it tips into stage 4? Stage 4 is not a gentle process. It is the part of the story where people discover that owning a promise of silver is very different from owning silver. Here's how it typically unfolds. Trading rules change. Margins are raised. Position limits tightened. Certain types of buying suddenly restricted. Deliveries are delayed or replaced with cash settlements, sometimes against the buyer's will. Liquidity evaporates in certain contracts. Prices gap, then trading halts appear more frequently. Physical premiums explode. You might see a quoted spot price of, say, $60, while dealers charge much higher prices for actual metal, or in extreme cases, simply post out of stock. There is no guarantee that events will play out exactly this way, but historical precedent, from the Hunt brothers to palladium, shows that when there are more claims than ounces, someone eventually gets left holding nothing but a legal argument. So what can an individual actually do? 1. Separate ownership from speculation. Trading futures or CFDs on silver can be a legitimate speculative activity if you understand leverage and counterparty risk. But if your goal is protection rather than a quick trade, your focus should be different. You want metal that does not rely on any promise. That means physical silver in forms that you control, not a spreadsheet entry at a broker. 2. Act while premiums are manageable. Right now, generic bars and widely recognized coins often sell for a modest premium, on the order of a few dollars over spot for common products, higher for popular government-minted coins. In a genuine squeeze, those premiums tend to widen dramatically, and availability can dry up. It is historically much easier to acquire metal before a rush than after. 3. Stick to liquid, recognizable forms. This is not the time to chase rare collectibles. Focus on forms the market will recognize instantly: government-minted bullion coins and standard bars from well-known refiners. The goal is to own metal, not fancy packaging. Liquidity matters when the system is under stress. 4. Size your allocation sensibly. For most people, that does not mean converting everything to silver. Think in terms of a 10 to 20% slice of overall assets devoted to physical precious metals, calibrated to your risk tolerance and broader financial plan. Enough to matter if there is a monetary shock, but not so much that you are overexposed to one scenario. 5. Control your storage risk. The entire point of owning physical silver is to reduce counterparty risk. That only works if you do not reintroduce that risk by handing full control to a third party. A home safe, a trusted safety deposit box, or a reputable private vault where you retain clear legal title and audit rights can all make sense. What you want to avoid is a situation where your silver is really just another IOU. Finally, zoom out to the monetary backdrop. Almost every fiat currency studied eventually loses most of its purchasing power or disappears entirely, and some research puts the average lifespan of fiat systems at around 27 years. The US dollar has operated as a purely fiat currency since 1971, which means we are more than 5 decades into an experiment with no hard backing. You cannot print silver. You cannot solve a physical deficit with an interest rate tweak or a software patch. Economic models can assume anything they like. At the end of the chain, factories still need actual atoms of metal. The real question is not whether the current system is perfect. It isn't. But whether you want to rely entirely on that system continuing to work smoothly while physical inventories tighten. If you can see the pattern, you have choices. You can wait, hope the story ends differently this time, and risk paying much more, or finding no metal at all if stage 4 arrives. Or you can treat silver as insurance, build a rational position while markets are still functioning, and let everyone else debate the headlines when the next halt hits. If this framework makes sense to you and you want to go deeper into how silver ties into the larger currency and debt cycle, subscribe and watch the next video. We'll connect the dots between precious metals, sovereign debt, and the derivatives complex that quietly controls most of global finance. People who recognize patterns early are rarely the ones shouting on TV after the fact. They are the ones who quietly positioned themselves before the crowd moved. The clock is still ticking, but you decide how you use the remaining time.